Okay, I've been looking forward to this. Here's a number that, honestly, it just stops you cold. This company is worth about $2 trillion. And the only part of it that actually turns a profit made about $4.5 billion last year. That's it.
2 trillion for 4.5 billion in profit.
From one segment. The rest of the business lost money. So the question for today is simple to ask and kind of brutal to answer. What exactly are you buying when you pay $2 trillion for that?
And whose 4.5 billion is paying for everybody else's bad year?
Right. So let's set the table. The company's SpaceX, which, get this, since February has folded in the AI venture XAI. Three businesses under one roof: rockets, satellite internet, and frontier AI.
3 businesses, 3 completely different temperaments.
Exactly. So Starlink, the satellite internet, that's the profit engine. About 11 billion in revenue last year, a bit over 4 billion in operating profit, and here's the wild part, that profit grew 120% year over
Year. Okay, that's a real number. I'll give you that one.
right? Then there's Launch, the rockets, around 4 billion in revenue, but it ran a small operating loss because, get this, the Starship development program is eating roughly 3 billion a year.
So the famous part, the rockets landing themselves, that bit doesn't actually make money.
Not right now. It's roughly break even, all the cash going into Starship. And then there's XAI, about 3 billion of revenue and an operating loss of over $6 billion.
6 billion lost in 1 year.
In one segment. Put it together, and the whole company lost about 2.5 billion at the operating line, nearly 5 billion on a net basis, and burned something like 14 billion in free cash flow.
So let me say the quiet part. Starlink's profit isn't really shareholders' profit. It's a subsidy. It's paying for the AI bonfire.
That's a fair way to frame it. It really is. And it got sharper this year. In the first quarter alone, the company lost about $4.25 billion. A year earlier, that quarterly loss was around $500 million.
So the trend is the wrong direction. Hold on. The merger took a nearly profitable company and made it lose money faster?
That's exactly what the numbers show. XAI merged in, and a near profitable business became a 5 billion a year and widening loss machine.
Great. Continue.
But here's the steel man, and I want to be honest about it, because this is the part I love. The launch business has a genuine, durable moat. Reusable rockets at a cost no Western competitor can touch. About 165 orbital missions last year. That's not a story. That's a cost advantage you can measure.
I'll concede the moat in launch. It's real. It's also the smallest, least profitable piece. Wonderful moat, wrong wallet.
And Starlink's lead? It's widening operationally. Around 9,600 satellites, over 10 million subscribers across 150 plus countries. And the regulators? They keep handing them more too. The FCC cleared another 7,500 satellites in January and freed up spectrum for direct-to-phone service.
All real. So here's where I want to do the inversion. The Munger move. Instead of asking why this works, ask what would make buying it a mistake. And the cleanest answer is hiding inside that subscriber number.
Go on.
Subscribers are up, but what each subscriber pays, the ARPU, the average revenue per user, fell 33%, from about $99 a month down to around $66.
Over roughly 2 years, yes.
So they bought all that growth by going into poorer markets and cutting the price. That's not pricing power. Pricing power is when you raise the price and customers shrug and stay. This is the opposite. They grew units by giving away price.
There's a test for that, actually. Real pricing power needs three things: units growing, okay, that passes, the price or margin holding, that fails, down a third, and competitors not also undercutting you.
Which also fails, because Amazon's Leo constellation just went into enterprise beta, and there's a Chinese constellation ramping. 2 of 3 fail. No pricing power.
Now, in fairness, they pushed through a price hike in May, $5 to $10 a month on the existing base, first increase since 2023.
One hike on a captive base into rising competition. That's a recapture attempt, not proof of power. I'll believe it when the price holds and customers don't churn out. Right now, it's a watch item, not a thesis.
That's fair. It's the thing to watch. But think of it like a leaky bucket, and I love this, honestly. The cost moat is real, water keeps coming in, but with no pricing power, the savings just leak straight back out as lower prices. You're scaling, but you're not, capturing.
Leaky bucket. I like that. Now do the AI part, because that's where the real money goes to die.
XAI, no durable moat. Frontier AI is a brutal, well-funded race. OpenAI, Anthropic, Google, Meta. Grok isn't a clear leader. But, and this matters, it's not pure burn.
Here we go.
No, really, there's a contracted backlog, real, signed deals. Google? Around 30 billion through mid-2029. Anthropic? Around 45 billion over about 3 years. Another few billion from a company called Reflection. Call it 75 billion plus contracted.
Okay, pause. That does sound like a lot. So, what's the catch?
The catch is the kind of revenue it is. That's renting out GPU capacity, compute by the hour, low margin cloud economics. It is not high margin frontier model money.
So, it softens the no path to revenue worry, but it doesn't rescue the profit. You're filling a stadium with people who barely cover the cost of their seat.
Well put, well put. And there's a supply constraint. The filing itself warns they can't currently secure enough chips. They're building their own fab, a joint venture, unproven.
So now let's actually price this thing. Because everything you've said is interesting, but the only question that pays the rent is $2 trillion a fair price?
Okay, let's build it from the ground up. Start with enterprise value, what you'd really pay for the business. Market cap around 2 trillion. Add about 29 billion of debt, subtract about 100 billion of cash. That nets to roughly 72 billion of net cash. So enterprise value lands around 1.95 trillion.
And against that, the sales are what? 18, 19 billion?
About 18 and a half. So enterprise value to sales is around 104 times. EV to EBITDA, nearly 300 times. And there's no PE because there are no earnings.
100 times sales. Let that sit for a second. 100 times sales.
And one caveat that cuts against the bulls, and it's a big deal. I credited them all that cash, but they're burning roughly 14 billion a year, and capex is annualizing toward 40 billion. That cash pile is melting. If you haircut it, enterprise value drifts right back up toward the full 2 trillion.
So the cash cushion is partly an ice cube. Fine. Now do the generous version. Build it up part by part and be kind.
Okay, some of the parts deliberately generous 10% discount rate. Starlink, on a rich multiple of next year's profit, call it 250 to 360 billion. Launch, strategic value plus Starship optionality, maybe 100 to 200 billion. XAI, including that backlog, heavily haircut for the burn, 50 to 200 billion. And the orbital data center idea, pre-revenue, 0 to 100 billion.
Add it up.
Generously, somewhere around 400 billion to 860 billion.
And the price today is 2 trillion. So even being generous, being kind, your word, you're paying somewhere between 2 and 5 times what the business is worth.
And an independent check agrees, roughly. Morningstar's fair value is around $62 a share, about 780 to 810 billion. That's roughly 60% below where it trades.
So this isn't a margin of safety, it's a margin of danger.
That's the phrase in the analysis, yes, a margin of danger. And there's one more cross check I love, because it's the inversion of a famous trade. Back in 2020, the classic deep value setup in Japan, companies trading below book value, 5 to 8 times earnings, fat earnings yields well above the risk free rate, huge cushion.
And this is the photographic negative of that.
Exactly. Negative earnings yield, there are no earnings, against a risk-free rate around 4.5%, with a hawkish central bank maybe even hiking again. So when the safe government bond pays you 4+% and the business pays you nothing, the math is simply against the buyer.
And before you wave at the recent sell-off, it's down about 30% from its high. That's not the market handing you a bargain. That's options-driven shorting and indigestion over the bond and the acquisition, not the business breaking. So there's no contrarian dip to buy here.
Agreed. That drawdown is about market plumbing, not fundamentals. And there's a slower overhang behind it, the lockup. The big tranche of insider shares frees up in December, more after. So more potential supply, not less.
Now, let me hit the thing that actually worries me most, separate from valuation. Capital allocation. Who's steering the ship?
Musk is a generational operator, no argument there.
For a minority shareholder, though, look at the moves. They stapled the cash-burning AI venture onto the crown jewel, a related party deal that benefits his own venture. Then, 5 days before the listing closed, a $60 billion all-stock acquisition of a coding company.
Cursor, Anysphere, about 3.5% dilution.
All stock, at peak narrative. That's the tell. When management is issuing paper hand over fist right when the story is hottest, that's wonderful for the company and the insiders, and a lousy entry price for you. Add dual-class voting control and a $20 billion bond 2 weeks after the IPO, and the minority holder is a passenger, not a partner.
And I can't really rebut that. Because it's structural, the voting control isn't going away.
So, before we land it, the orbital data centers, the big visionary thing. Computers in space, running on solar, cooled by the vacuum. Sell it to me, and then I'll knock it down.
Okay, this is genuinely clever. I mean it. Earth's running into walls on power and water and permitting for AI. But space? Space gives you near constant sun and a vacuum to dump your heat into. And if one company is the launcher and the manufacturer and the network, it could become the railroad and the utility and the cloud of orbit all at once.
And the knockdown?
The whole thing depends on Starship working at a fraction of today's launch cost. And even Google's own estimate puts the break-even somewhere around 2035. The hardware is essentially disposable on a 5-year clock. And Musk's track record on timelines
Is that he delivers the impossible, eventually, and always late. He targeted 25 Starship launches last year. He flew 5.
Right. So the honest read is, moderate to high odds the capability eventually exists, but low odds on the timeline and economics the current price implies. Which means it belongs in the free optionality bucket. You want to pay roughly nothing for it.
But at $2 trillion, you're paying a lot for it. So the moonshot doesn't rescue the thesis. It confirms it. Let someone else fund the rocket to the data center.
Which brings us to the one lesson, and it's this. The genuine moats here are real. Launch and Starlink are not stories, but you're paying about $2 trillion for roughly $4.5 billion of current profit, plus a pile of optionality. A wonderful business, bought at a wild enough price, stops being a wonderful investment. The price has to leave you a cushion, and here it leaves a crater.
And the truly contrarian move isn't buying the historic IPO dip everyone's excited about. It's being willing to say no to a $2 trillion story the crowd is euphoric about.
The math is against the buyer. That's where this kind of analysis lands.
And a quick word before we go.
This is general information and education only, not personal financial advice. It doesn't consider your situation. Do your own research or speak to a licensed advisor before acting.
See you next time.